Hi, everyone. Welcome back to the Future of Finance podcast. I'm your host, Marissa Wood, owner of Union Financial Services. And today we have a really exciting episode ahead of us. We are joined with industry expert Marty Willenborg, who's had over 40 plus years in the financial services and insurance industries. And today he's going to share some really exciting concepts on how he's been helping his clients for over 40 years with estate planning strategies and helping his clients achieve tax-free income when they retire using something called the Kaizen concept. So tell us a little bit more about how you got started in this industry.
Okay, like you said, it was over 40 years ago, Marissa. It was actually my son's 10th birthday. I was going out the front door to take him out for pizza and stuff, and the phone rang. Well, I run back to get the phone, and a friend of mine that he was actually in my wedding party called me and says, "Hey, Marty, I've just been promoted to a sales manager with a company called Prudential." He said, "I'd like to talk to you about maybe getting in the industry." And I said, Ron, the last thing I'm going to do is sell life insurance. I don't want to do any of that. I've never sold a thing in my life, and that would probably be the last thing I would ever sell. He said, well, just come down and talk to me. And again, we'll talk about it. So the next day I went down and talked to him, and lo and behold, I did get started with him because everything he talked to me about was the opportunity, the financial rewards, helping people. And I really liked that. And the reason I chose life insurance, Marissa, was I wasn't in the insurance business, but I went to the doctor with a bad head cold when I was 25 years old. You know, you don't go to the doctor when you're 25, but my wife set up an appointment for me to go, and I went. And when I went there, I was really congested. Well, he said, take off your shirt. I want to check your lungs. Well, when I took off my shirt and he checked my lungs, they found a spot on my shoulder, chest there, and he asked me how long I've had that, and I says, "Well, I've had it for 2 or 3 months. It's been getting bigger and it's getting blacker and getting a little lump under it." Well, to make a long story short, he said, "We're taking that off tomorrow. You're going to come back in here." So I went back in the next day. They took off part of my shoulder here and sent it in, and I go, "What's going on here?" And he said, "Well, we're just checking. We want to make sure it's benign." And of course, that scares you. I'm 25 years old, think you're going to live forever. So back then, you had to wait about 10 or 12 days. Well, when it did come back, I went in for the appointment, and I knew it wasn't going to be good because they put me in a room with another gentleman, and unbeknownst to me, he was kind of like a psychiatrist or something because they don't know how you're going to react. But anyway, they said, "Marty, we hate to inform you, but you better prepare because it's a malignant melanoma, and the odds are very good you're not going to be around next year at this time." So again, I had to go home and talk to my wife, and Elena, and she goes, "Hey, what's going on? What did they find out?" Well, I remember walking up the stairs. We saved about 5 years to buy a new house, and we just bought it in June. I'm diagnosed in September, and I said, "Elena, it's not good looking out the kitchen window at my 4 and 2 year old out in the backyard playing." Thinking, son of a buck, I'm never going to be able to play ball with my son. I'm never going to walk my daughter down the aisle. And she knew something was really up. And I said, "Elena, yeah, they found a tumor, a malignant melanoma, quick cancer." And I said, "The odds are very good I'm not going to be here next year." Of course, we both cried. And what are we going to do? What are we going to do? And I says, "Well, Elena, I've got that old policy I pay $44.88 a month on every month, and I complain about it because I didn't understand it. So I go back to my sock and underwear drawer and dig it out." And I come out and I show it, put it on the table. It was a $40,000 policy. And I'll never forget, I put it on the table. I says, "Elena, here's $40,000. And she looked at it, turned it around and shoved it back at me. And she says, "Marty, what am I going to do with that? We just took out a $40,000 mortgage. I have 2 young kids to raise. I'm not working because we figured you work, I'll raise the kid." So dumb, unbeknownst to me, I said, "Elena, I'll go get some." Again, I wasn't in the industry or the business. So I go down and apply at a policy. And I tell the salesman or the receptionist I'd like to buy some life insurance. Well, all the people in the room come loosen or tighten their ties up and come out and see me. And make a long story short, I applied for 250,000 of term insurance, and the gentleman started asking me my date of birth, social security number, and he started asking the health questions. And he says, "Hey, are you a smoker? Have you ever had any cancer, heart trouble, anything like that?" And I said, "Yeah, about 2, 3 weeks ago, they found a melanoma on my chest, and it's not good." Well, he took the paper application, Marissa, and he tore it in half right in front of me. And I says, "Hey, what are you doing?" He says, "Marty, I sell a funny product here. When you don't need it, you can get as much as you want, and the day you need it, you can't get any." So that was to me. Then I knew I wasn't going to get the insurance, and thank God I made it past that couple of years. But anyway, when I talked to the gentleman that called me, I went down and talked to him. I really like helping people, and I know what it's like to be told, "Hey, you might only have it 6 months or a year." And that's the first thing that popped in my head is, who's going to take care of my kids and family and everything. So I'm a big advocate for beneficiaries, children, spouses, and grandchildren and stuff. So I really like doing that. And Marissa, you know me well enough. I've done it for 44 years now, pretty much, and it's just amazing with and fine. But that's when I got into this business.
That is so true with life insurance. You can get as much as you want when you feel immortal, when you feel as though you're not going to
Yeah.
die anytime soon and you don't have any health issues. But then all of a sudden, as you age and you're diagnosed with this or that, it becomes harder to get that life insurance. And so putting it in place as young as possible is crucial, really.
Well, Marissa, I mean, you bring up a good point, but I love doing this business. I love everything about it except one thing, and that's naturally delivering the death benefits. I mean, that's the worst time in people's lives. But 40 some years of doing this, I've pretty much heard everything, when it comes to life insurance and stuff. But there's one thing I've never heard in 44 years, and that's when I deliver a death claim, I give them the check and stuff. I've never heard anybody say, "Marty, that's too much. You better take some back." I mean, we all smile about that. I still smile about it, but so I've never heard that where somebody said, "That's too much money. We're going to have to give some back." But I've heard way too many times, "This is all we get. Marty, what am I going to do now? My husband's gone," or something like that. And what am I supposed to do? And I've heard that way too many times. So when you look at this stuff, you got to really look at annual reviews with your policies. I can't tell your clients enough and people out there, make sure that you at least review your policies once a year with somebody. I mean, Marissa, I found people 70, 75 years old still have their mom and dad down as beneficiary who have been gone for 15 years.
Yeah, that's probably common.
Well, yeah, very common. I've had people that they still had their children down with, again, reviewing your policies is really, really important.
Yeah, that's a no brainer for anyone that has insurance. Let's review it. Maybe we can buy you more coverage for the same amount that you're already paying, or maybe we can lower that annual payment that your premium is, and you can get even more insurance or the same insurance amount. But we don't know until we review it. And luckily, we've partnered with Marty as a back office support. We're a small family business, but we need to outsource some of our expertise to people like Marty who can help us design these policies, review them, make sure we're serving our clients to the best of our ability, and do it with someone that has over 44 years of life insurance experience. So our clients really are getting a ton of value through our partnership with you, Marty.
Thank you.
And so we've kind of covered the surface of the value that life insurance has in terms of death benefit. But what I really want to dive deeper into with you today is all the living benefits that you can utilize life insurance for and some strategies that you've designed to help people take tax-free income and get a crazy return on investment. So tell me a little bit more about permanent life insurance.
Okay, the two types are permanent and temporary insurance or term insurance, and that's the cheapest because again, you just buy it for a term, and when the term's up, you're done. So you can pick the term you want, 10, 15, 20, 30 years. It's going to be the cheapest, but you have to understand about term insurance is 98.6% of term insurance is never paid out in a death benefit. So that only leaves about 1.4% is actually paid out as a death benefit. All right.
And why is that?
Well, well, congratulations. If you're one of the 1.4% that's paid out as a death benefit, you just beat the insurance company pretty bad, but you're dead.
But you're dead. It's so
Well, they
true.
just know, insurance companies know how many people are going to live, how many 35-year-olds are going to live this year. They have it really, really good. So they can charge a 10-year term. They just collect that premium. And if you're one of them that pass away, it doesn't build any cash or anything like that. So 120 years ago, they came out with whole life insurance where you build cash value in there. So someday you can take the cash out and keep your insurance permanent, then you never run out. Okay. But then about 20 years ago, they came out with something called universal life because a lot of the insurance companies were making money off the cash value. And the client wasn't, they'd get a small dividend. Well, the insurance company's making all the money. So us consumers said, hey, we want to be able to make some money off of that. So then the insurance company switched to something called, the people said, well, I want to invest my cash value into like the market. Well, then a product called variable universal life came out. Same thing as universal life. You didn't have a fixed amount, but you got to play the market. Well, them things were so expensive. But again, when anything was variable means it can do what? It can go up and it can go down. So if you lost money during the year, then your policy took a hit for that. And they're very, very expensive because they had all the charges going with that. Well, then a few years after that, out came indexed universal life, IUL, it's called. There, you're not in the market, but again, it builds the cash, and you get to pick like an index, like the S&P 500, or different scenarios, that you can pick, and then that index does. That's what you get on your policy. But the nice thing with them, Marissa, is they have a 0% floor on them. You can't lose any money as your cash value grows. So you get the growth. The anniversary comes around. Next day, you stop. You stay there because zero is your floor for the next year.
Yeah, it's almost like a staircase. You're just, every time you earn, you lock in, you go up that next step. The next year, you go up again, you lock in, you go up that next step. And what a beautiful way to make money knowing that you're never going to suffer a loss.
Yep. It's like walking upstairs with a yo-yo. Yo-yo
Yeah,
goes up and down, but you still keep going up the steps. So
that's a great analogy.
yeah, that works real well. So what I've done, I was going to retire 5, 6, 7 years ago, and I came across this product called Kaizen, Kaizen, and this is a concept I really fell in love with because again, the way to qualify for a Kaizen, I asked a lot of my clients, number one, are you saving enough for retirement? Now, 95% of them said, well, Marty, we could always be doing more. I wish I could put more away. So be it. I'd say, okay. I said, let me ask you another question. How do you feel about volatility in the market? And again, they all hated it. They had lost money. It took 5 years for it to get it back and this and that. And I says, okay, if I could find you some extra money, if I could protect it so you can't lose it, how do you want to be taxed on that in your retirement? Well, they all look at me and they like I'm a dumb bunny. They say, well, Marty, if that's tax free, that would be everything I've got is taxed. 401k, IRAs, I own land, all that stuff's going to be taxed someday. I says, okay, let me summarize then, and I'll show you a concept that I can find you extra money, I can protect it, and I can get it to you tax free. And that's the way I would sit down with people and I would show them just how this product works. Marissa, it's called premium financing, where you borrow money from the bank. Okay, now don't get nervous and tune me out, but everything is done with the policy, the life insurance policy. You're not putting your house up for mortgage or your farmland or anything like that. The policy is the collateral. All you have to do is qualify for the policy, And again, everything, the trust and everything is set up through the policy. That's the only collateral you have. But here's the deal. You have to make a 5-year commitment. All right. You pay 5 premiums, and then the bank will match that with 5 premiums. So there's a whole premium going in here. Then you're done. You're done for the rest of the contract. The next 5 years, the bank pays the whole premium. Okay. So for every dollar you put into it, the bank is matching it the first year, and the next year they're putting $2 in. So every dollar you put into this program, the bank is putting $3 in. All right. From the 11th year to the 15th year, nobody's putting anything in. We're just letting this thing grow and do its thing into the index and see how the index does. But please remember, you have a 0% floor, so you can't lose any money with it. Then after the 15th year, the bank will go into the policy, take a loan against to get their money and interest out, and then you get what's left. Okay. So what you're really doing here is using leverage, and leverage is not a bad thing if you know how to use it. Okay. So it works just like a mortgage. I bought a $350,000 house. I put what was it, about $60,000 down on the house. Okay. And again, as that has grown, my $350,000 house is now worth about $700,000. And I paid down that loan. So what I did is I used the bank's money, okay, to take it from 350 to 700. And again, so my down payment was kind of like the 5 payments on a Kaizen. Works the same way.
So years 1 through 5, you're putting in your premiums and the bank is matching you. And then years 5 through 10, the bank is paying the whole amount. What you were putting in plus what they were putting in, they're paying that whole amount years 5 through 10. And then we let it marinate a bit. Year 15, the bank takes back the money they loaned you. And then the policy is yours from there on out to borrow from, to take from, correct?
Yeah, you can, if you have kids in school, you can use it for college funding. If you want to buy a different house, all that money after all them 15 years is yours. Okay. So again, you can do whatever you want with it. Now, again, if you let it sit, that's when you can pull tax-free income out. I had one the other day, just for an example. He put X amount of money in it, and he's going to do it. You have to commit to 15 years. I'm going to be upfront. And, it's a 15-year commitment, 5 from you, but you got to let the thing do its course. It's never failed with all the back testing they've done. And then when it happens at age 65 or whenever you want, you start drawing income out of this thing, and it's all completely tax-free. So that's the beauty behind this thing, that people can get. Number one, you find them extra money. Number two, you protect it. Number three, you're getting them tax-free income.
This is fixed index universal life insurance, because a lot of our listeners and clients might already be familiar with fixed index universal life insurance, but this is just taking it to another level by adding premium financing, adding that bank leverage. So it's taking the same concept and product, but just enhancing it.
Yeah, it's like it's on steroids or something, because you got to understand, number one, it's a life, but the company that designed it didn't design it to see how big a policy we can sell my clients. It's designed for one thing and one thing only: tax-free income. They did that for their employees 22 years ago, and that's how this thing all developed. So the insurance cost, we don't want to sit here. You don't want to spend a lot of money on insurance, and the cost of insurance. So again, we want to keep that as low as possible. All right. But here's the thing, Marissa, not everybody can get into this. Number one, you have to have income of probably 100,000 or more household income to get into it. Okay. Because again, you just can't do smaller policies and stuff. It just doesn't work. Okay. So if you have a household income of 100,000 or more, if you're married, you and your spouse make more than 100,000, you can look at it. The second qualification is you have to be you have to be relatively healthy. If you're a diabetic or what they call a special class 4 or more or rated on insurance, it doesn't work because again, the insurance costs get to be too much, and it's not designed for that. So if you're relatively healthy and you and your spouse, if you're married, make more than 100,000 a year, give Marissa a call and get a what if scenario and see what this thing looks like.
And what is the minimum premium every year? Because I know that has been something that has caused this to not be a good fit for some clients. And we've gone just the traditional fixed index universal life route. What is the minimum that you have to put in every year for 5 years?
Now, again, what you're looking at, the minimum premium is about $22,000 a year. Okay. So don't hang up on us here, but you take that times 5 years. But because I've had one that the gentleman was putting in about 25,000 on his wife, put it away for 5 years, and at 65, they could pull out about $234,000 a year based on 6% interest. Now you can do that for 26 years. All right. So if you take 235 times 26 years, that's about $6 million tax-free income. And if she died on her 90th birthday, it's what we project these things to. There's still about 1.2 million go to her heirs, her children, charity, or beneficiary. So on a $125,000 investment, she herself is going to get 6 million back of income, no taxes, but her heirs are still going to get a little over a million. So
Incredible.
if you did the math, that's $7 million, $7 million on a $125,000 investment. That's why, Marissa, I didn't retire. Uh, People just really, really like this concept.
Now, those numbers are staggering. And obviously, the wealthy use leverage to build wealth. And this is a classic example of it, but something that's going to come to mind probably for a lot of our listeners. And it even came to my mind when I first heard this concept is it sounds too good to be true. So how is this not too good to be true?
Well, you bring up a good point, and I hear it all the time. The three biggest objections, that's one of them right there. It's too good to be true. But the only way this would be too good to be true is if Marty paid the premium. And that's not going to happen, right? But you got to understand, too good to be true. Number one, you have to qualify, want it, but they don't qualify health wise, so they can't do it. The second thing is you have to commit to them 5 premiums. All right. Not everybody wants to commit to it. And like I said, 22,000 a base or 25,000, that's a lot of money. Okay. Then the third thing again is that you have to give it some time to work. You have to commit to the 15 years. If you can commit to the payments and you can do it for 5 years, you're done. Let the bank leverage work and commit to 15 years. Then this is just right for you. And it's, again, if you can't do them two or three things, then it is too good to be true. But again, the wealthy, like you said, the wealthy have been doing this for a long, long time.
Exactly. And it's important for people to remember that that 401k that they are building up for retirement, that's all going to be taxable at an unknown rate in the future, whereas this type of policy, those tax-free income distributions, if you're taking out $100,000 a year from your FIUL policy, that's a true $100,000 in your pocket. If you're taking that same 100,000 from a 401k, depending upon your tax rate, you might net 70,000, you might net even less than that. And so you're truly getting a great return on investment by it being tax-free and having that peace of mind for the future that you don't have to worry about Uncle Sam in your retirement plan is huge.
Well, every illustration I run, Marissa, with my agents like yourself, I show the 4 scenarios. I show them Kaizen. The next part, let's do this without borrowing any money and just do a life insurance policy without the borrowing. And then the next thing, let's put it in something that's after tax, savings account or something like that. And then let's put it in a tax deferred vehicle like an IRA or something. And I lay all 4 of them right next to each other and let you pick which one does the best. And that usually works out with the Kaizen because of, you just said it, because of all the tax advantages. Okay. But one thing I want to get across, Marissa, is that not everybody can afford premiums for Kaizen. All right. Or not everybody wants to be that aggressive. I have a lot of clients too. They want to do this concept, put money away, They want to not pay taxes on the growth, and they want to get it at it tax free. That's been around. I've been doing them for 35 years. It's called LIRP, LIRP, which is life insurance retirement planning. And I have some folks that will put five or $10,000 a year away for 5, 8, 10 years, and then start taking income out. I do a lot of them illustrations all the time too. Okay. A bigger one right now, it's called the GWT. A lot of acronyms in our business, but again,
Is.
the great wealth transfer. That's where parents or people like myself, maybe I'm too old to do it, but I can do these on my children or my grandchildren. I mean, I had a gentleman, a pharmacist here that he had a 19, a 20-year-old, both in college and 22 years old. He put $20,000 on each of them for 5 years. And again, based on 6%, they were going to get about close to $300,000 of income at age 65 till 90. So you take 300,000 times 26 years, about 7.5 million tax free, and he was putting 100,000 on each of them. He was a pretty well off guy, but again, it just worked so beautiful for him. And the way they qualified, the kids had to qualify health wise, but financially, dad and mom had to qualify, and he had 400,000 of income, net worth of about 4 or 5 million. So he qualified, and everything was fine. I wrote them on a Monday morning, and they were all issued, and everything was ready Friday afternoon already. Took 5 days, but and the referrals he gave me, Marissa, were just great because of all the advantages I'm talking about. But please, anybody's even interested in this, give you a buzz and let's run an illustration. Doesn't cost anything. You can do all the what ifing if you want. And if they really want to go in and play around with this, Marissa, you can send them and they can go in and do everything. They can investigate everything. They can get 98% of their questions answered and do their own illustrations using their amounts of money just to see what that will do. If they're even interested in that, get a hold of you and we'll make sure we get them the email.
Yeah, because, there's multiple routes that we can take this. Like you said, the tax efficient wealth transfer for grandparents and parents that they can fund for their children or grandchildren. And then there's doing it for your own retirement plan. And then, if we don't want to look at the bank leverage, maybe if we just want to look at a couple $1,000s a year, that's what we can afford and that's what makes sense for us. Or we need income sooner than the 15-year mark. We can also look at that traditional fixed index universal life policy, which a lot of our clients have already taken advantage of. But if any of that is appealing, or if you want more information on this Kaizen, using the bank's money to benefit, your future retirement, wealth transfer, legacy plan, and using that as leverage, if you have questions on that, by all means, reach out to us. Go to our website, union-financial.com. We can schedule a phone call, and we have Marty as our resource at Asset Marketing to help us run these illustrations and to answer any questions that I might not be able to answer. I have another resource for you, and that's been a game changer.
Again, with Kaizen and things like that, I mean, there's a reason it's called life insurance. Use it during your life, okay? And you can't find a better vehicle if you want to leave a legacy to your children or your heirs or charity. That's the best vehicle out there. Do that all the time. People leave lots of money. Uncle Sam gets none of this. So Uncle Sam doesn't want you guys watching this video with Marty involved.
No.
Yeah, he doesn't like me. I pay enough taxes during the year, so I don't need to give him more at the event of my death.
Yeah, I remember you told me the 4 bucket concept, that when it comes to legacy planning, there's the 4 buckets your money can go. You can spend it all. You can give it to your heirs. You can give it to charity. Or if you don't plan properly, it can go to the IRS. And if you don't want the majority of your assets going to the IRS, let's have a conversation. Let's utilize these great strategies that exist. And that's why we wanted to put out this podcast, because not enough people know about these amazing investment vehicles that are out there, and it's our job to spread the word and to educate the public on this.
I'm a pretty good advocate. I love life insurance. I hate delivering death claims, but I've seen what it's done for families, Marissa, and it's just probably the bleakest moment in their lives, but you're the one thing that gets them back on track and puts kids through college, pays off houses, gives them income. So again, I won't get too mushy on this, but that's the part that motivates me for over 40 years of doing this.
That's about all I have for today. I'm sure we'll have you on a future episode because you're always a wealth of knowledge. I appreciate you taking the time today. And for everyone that is watching, like I said, head to our website if you want to schedule a call or a meeting or just have a couple follow-up questions. And make sure to tune in every other Thursday for a new episode of the Future of Finance podcast. I'm your host, Marissa Wood. Thank you, Marty Willenborg. And we look forward to helping you live a better financial future. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
The Kaizen strategy is dependent on the client making contributions for the first 5 years, therefore not defaulting on the policy, which could result in policy lapse and surrender charges. The client will not have access to the policy, the cash values, the death benefits, or the living benefits until the loan is repaid and the assignment is released. The lender has the right to discontinue funding new premiums, exit the market, or to demand loan repayment based on the terms and conditions signed by the master trust. See the master trust documents for additional information. There are some exceptions to this rule. Please consult a tax professional for advice concerning your individual situation.